Welcome to our IG Lives for Liam 2024. Welcome, friends. As we have more of you pop in, I want to remind you that myself and Dwight Nicholson are putting together these IG Lives for your benefit to sit down and educate and bring awareness to life insurance and how it works, the ins and outs. So, stay tuned with us. We're going to keep this one short and sweet. There he is. Hello, sir. How are you?
I am doing well. Doing well. How are you?
Good, thank you. So are you ready? We've got a big one tonight. We gotta basically start right away because it is decoding life insurance and finding out which type is right for you or understanding the different types that are out there, basically,
Hmm.
right?
Yes. Yes.
Before we get started and I get Dwight to get us started, I want to share with you a couple of things. Number one, just a reminder that we are sharing basic concepts. We are sharing basic knowledge. We are not sharing advice for anyone in particular. If you want specific advice, feel free to reach out to us. We are more than welcome to sit down with you and go through your specific situation because everybody's situation is different. Secondly, we won't be talking about specific companies because we are broker dealers and we have a bookshelf, in essence, of different companies that we work with, and no one is better than the other. Again, everybody's situation is different, and that's why we do a full financial needs analysis when we sit down with anybody who is coming to us for the first time. That being said, the purpose tonight is to share with you the different types of insurance that are out there and give you the information that is very much needed. Save you the effort of having to go through Google and having to decode it yourself. And lastly, I think that both Dwight and I are on the same page when it comes to knowing that at the end of the day, whatever it is that you have, number one, we have said it before in our previous lives, make sure you understand what you have. If you don't know specifically, sit down with someone who can read the jargon and understand and decode it for you. And secondly, something is better than nothing,
Mhm.
right? I mean, we would much rather you be fully covered, but something is better than nothing. Make sure you don't leave loose ends, right?
Yes.
When you're gone. So that being said, sir, we
Mhm.
are going to jump right into it. Our first decoding is decode for us a little bit about term insurance and how that works.
Yes. So term is probably perhaps the most popular type of insurance. The history goes back to World War II, I believe. The whole idea behind term is to really provide income replacement coverage for a period of time, right? So it's generally now designed to say, let's say, I'll give you an example. Let's say you have a mortgage that's amortized over 20 years. Okay. Let's say your mortgage is $1 million. Unless you have $1 million of assets, or let's say just savings of a million plus, where if in fact you were to pass away, that investment or that asset can be used to pay off the house. Having a term policy is a good way for you to cover the largest expense that you have during that period of time. So that way you don't have to dip into your own personal assets or savings in order for your loved ones to be able to pay off that asset, right? Or pay off the house, all right? Other examples are if you have a lot of debt, right? Most people have they accumulate the most debt during, I'd say, the ages of between 25 and let's say maybe 45, 50, right? They
Right.
have the most debt. If you look at their or their timeline, it's good to have a term that covers any major debts that you have during that period of time. So again, if in fact something does happen to you, there's enough to pay off debt, pay off your mortgage, um, final expenses, as well as, funeral expenses, right? Those are the expenses that pop up once somebody passes away. So term is generally good. There are pros and cons, right? The pros are it's good for a short period of time. It's generally inexpensive, right? So hopefully TV ads don't come for me, but the ads that you see on television, you generally see you can get 500,000 for $30 a month, that type of stuff. But if you freeze frame the ad and you read the fine print at the bottom, you would realize that they're looking at a term 10 policy. I've done this so many times. So I encourage you, don't believe me, try it yourself, right? So it costs, it's very inexpensive. The cons are it's like renting, meaning if you don't actually exercise it or put in a claim, which means you don't die, everything that you've invested into that policy, it is gone, meaning there's nothing coming back. It's kind of like renting, right? You don't ask your landlord, you've been there for 5 years, say, hey, man, I've been here 5 years. Can I get some of that money back? It just doesn't work that way, right? So there are pros and cons to a term insurance. Again, and as I said in my last post, you want to use it for your scenario and you want to use it effectively, right? Now you can combine that with a permanent, but that's gonna, that's another topic. I'll leave that for you to kind of talk to, but that's really what a term policy is good for.
Can I ask you, I know some people will probably ask this question with regards to a term. I know I've had it from other clients is, will my rates go up every year?
Yes, very good point. Your rates will, depending on the nature of the term. So let's say you have a term 10 or term 20. If you were to outlive that policy, you have an option, right? Either you allow the policy to renew or you let it lapse. Most policies, term policies, are designed to renew, which means every time, and then think of the foundational laws of insurance is every year you're older, the cost of insurance goes up, right? So let's say you've got 10 years at $30 a month. You're alive at year 11, the premiums are going to go up. Now, how much it goes up can be exponential, right? I can tell you for a fact, I've sat with retirees in their 60s, 70s. I've showed them their own policies that are $500 plus. I think the highest I've seen was $1,100 a month, right? So that is the danger of having a term policy if it's not set up and structured correctly, is you may end up with a policy later on when you actually need it that most people generally can't afford, or they shouldn't really have to pay that much money for a policy. So you want to make sure that you use term for the pros and subsidize the cons with maybe a permanent policy that allows you to get that longevity as well as reduce the cost.
Gotcha. So to anybody who is asking, your rates are locked in for the period of time that you have that policy for. So if it's a 10-year term, it's locked in for 10 years. If it's a 20-year, it's locked in for 20. But just like Dwight said, I've seen it as well. And this is actually, my mom was my first client outside of, sitting down and myself and Kevin having our policies done by our advisor within our firm. But my mom was my first client, which was, understanding that she was paying $65 for $250,000 of coverage, and she was turning 63, and her insurance was actually going to go up to $400 a month, and we didn't even realize that.
Yeah.
And I think this is why I'm here in this industry, is because had I not been in the industry, it would have automatically gone up. And I will tell you this, if it would have gone up automatically, that $400 would have gone out my mom's pocket. Immediately, she would have said, cancel it because it doesn't work. Cancel it because it's a scam, because we weren't informed. And we actually had someone who sat with us, gave her the option, showed her, but then never called her back, never ever. You follow it up in the 9th year at least to say, hey, it's going to come up for renewal. Maybe we should take a look at what options you have. We never happened. So, make sure you understand how that renewal will affect you.
Yeah.
Right.
Yeah. Yeah. Really important point. Yes.
Yeah. So we've got term.
Mm-hmm.
And I'm gonna take permanent on the permanent side here. I'm gonna share with
Yes.
you how that works. Dwight, chime in with a few things if you feel if anything else is needed.
Mm-hmm.
But the opposite. So for a term being you are covered for a short period of time, 10 years, 20 years, 30 sometimes. Some policies will allow you to pick your term, so you could pick 17 if that just happens to be the amount of time you think you need.
Yeah.
The opposite of that is having a permanent policy. And permanent policies work in the way that you are, let's say, 30 years old today.
Mm-hmm.
The expectation is you will live to 100. Like that's the calculation is that you will live to 100.
Yeah.
So what an insurance company does is they take your cost of insurance from today's age to age of 100, find your average, right? And basically give you one premium that you will pay from age 30 to age 100. Some policies you can structure to pay a little bit less, so you could pay it off in 20 years.
Mm-hmm.
Understand that there's no free lunch. Your premium will be higher because you're condensing the time period.
Yeah.
And essentially what happens is at the beginning, when we compare, a term to a permanent, and it is the same person, the same 30-year-old, the same 500,000, 250, whatever it is, you compare apples to, essentially apples to apples almost.
Yeah.
Um, let's talk about it like a green apple and a red apple, the apple family, but
Yeah.
they're different, right?
Yeah.
When you compare it in a permanent policy, you look at it and go, well, I'm paying so much more versus the term. Why wouldn't I just get the term?
Right.
The reason why you wouldn't just get the term and you would take a look and see if this is an option for you is because that premium is never going to change. It's never
Mm-hmm.
going to move.
Yeah.
And up front, what you are doing is you are paying into something called a cash value, like a fund within your policy is being invested.
Mm-hmm.
And that investment essentially, I mean, your cost of insurance has got to be paid somehow. And
Yes.
if your premium is not going to change, the amount of dollars that you're putting towards it per month is not going to change. Where is that money going to come from? It's
Exactly.
going to come from your investment upfront, and that will take care of your cost of insurance for later so your premium doesn't change.
Mm-hmm.
So there are pros and cons to a term and a permanent. There are pros and cons to everything.
Mm-hmm.
But I mean, my opinion and the way that I look at families is, I know at the very least I'm going to have final expenses.
Right.
Some people will say, hey, listen, you know what? I'm not going to have a mortgage for the rest of my life. I'm not going to
Mm-hmm.
have $20,000 debt for the rest of my life. My kids will eventually turn 20, 21. They'll be on their own. They'll go off. Financially, I won't be as responsible for them. The car will be paid off. So all those major responsibilities will be taken care of.
Mm-hmm.
But yeah, you know what? I never want to put that final funeral expense on my family's shoulders.
Yes.
So a lot of families have sat together that we've sat with. That's what we do permanent for. We do it to cover your funeral costs. We do it to cover, some estate costs and so forth.
Mm-hmm.
And doing it up front when you're in your 30s allows you to lock in that premium so that it doesn't change later.
Exactly.
Right. And that, going back to my mom, when we sat down and we looked at the renewal for her term, at that point, at her age, at 63, we were able to see that her ability, her budget at this point now was not $300-400. She was going to
Mm-hmm.
retire.
Right.
Her budget was now $80. And at that age, the amount of insurance that she could get was 17,000.
Wow.
$80 a month for 17,000. Obviously things change, over time. Some companies become more competitive with their premiums, but I mean, it's still not that different today,
Yeah.
10
Yeah.
years later. And you look at it, 17,000, it's okay. It's not bad. But you look at my mom, had she had known upfront how much it would cost her at 63 to get some permanent insurance, I know for a fact she would have started earlier.
Yes.
She would have started earlier because she could have gotten more.
Hmm.
And she could have thought, hey, listen, I'll take care of my funeral, but I'm also going to leave a little something to my granddaughters, you know? I mean, we didn't have them yet, but some people like to look at it that way. So within a permanent policy for families that are listening, there are two different types. There's a whole life and there's a universal life. And the key differences to what Dwight said that term is like renting. Granted, you can rent for 10 years and you could go back to your landlord and say, I've been a great tenant for 10 years. Can I get some money back?
Right.
Not possible, right?
Yeah.
With your permanent policy, be it a whole life or a universal life, you could pay into it for 10 years. And if you funded it properly, you could potentially look at what you have in there and borrow from your own policy
Mm.
for needs that you may have,
Yeah.
right? Or let it grow for the long term. So the difference between the two, between a whole life and a universal life, really comes down to the flexibility. A
Hmm.
universal life allows you to be more flexible.
Yeah.
It does allow you to make some changes, have
Hmm.
some what we call premium holidays.
Right.
And if you come into a hardship, you can't pay your premium,
Hmm.
you can dip into your cash value to pay your premiums and keep your policy alive. Whole life is a little bit more strict. The insurance company takes on 100% of the risk with the investments. So again, there's pros and cons to both scenarios, to having either or. But listen, if you are thinking of, I need at least, let's say 50K for the rest of my life, lock it in when you're younger.
Yeah.
Lock it in when you're younger. Take a look at what options you have within the whole life and a universal life and see what's out there for you, what's right for you, right?
Yeah. 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 No, and having the options on the permanent side is always, it's always good, right? Because you have options. I think when it comes to life insurance, like I said before, I think everyone thinks that there's one type of life insurance that just they generally correlate it to like car insurance, right? And it's just not the same. They're just two separate things, right? But having the two different types of permanent where you have a little bit more flexibility just means that there is something for everyone at every age and every stage of their life, right? Um so to your point, it's extremely important to understand what it is that you have, right? And this is what I like about how you operate, how our firm operates, how we train our agents, is to really customize the plan to the individual, right?
Mhm.
It's not a one plan fits all. It's let's really look at what plan is best for you. How can we maximize that insurance plan, which of the permanents will be better depending on your age, but can depending on the stage of life that you're in, right? So um really good points on really understanding how that works.
Exactly. So those are like three main types. We talked about term, we talked about permanent being divided into universal life and whole life. Now listen, we also know we are broker dealers and we know that there are scenarios when there are individuals who did not get insurance in time,
Hmm.
right? And something did happen. We've seen them many times. Someone who did not get it in time and goes, okay, well, I guess I'm out of options. So, Dwight, is that true?
So, and again, I come from a perspective of having so many conversations in a lot of cases, right? And and I'll be honest with our industry, um, companies are generally trying to ensure the more healthier people, right? Why? Because it's less risk, right? I mean, if you run a business, you don't necessarily want to launch a business so that you can have the highest risk. It's like, how do we have the less risk, right? So let's so so they generally would turn down approving someone with a health risk. Okay. Now, as you mentioned, because we're a broker dealer, it allows us to give a level of hope to people that may have been turned down by other providers for whatever health concern or health history that they have. We have providers that we can say, hey, um, you know, here is the scenario. Here are the health, here's health history of that individual. They are more lenient towards providing that coverage for that individual. And they do so in what's called a guaranteed issue, right? Now,
Mhm.
again, managing the risk, a guaranteed issue allows you to get some level of coverage, which is generally designed for final expenses, meaning, yeah, you need to pay for the funeral, right? Somebody's got to pay for it. So I tell my clients, I said, especially if they're young, I get these, sorry about the animation,
Yeah.
right? Forget these animations aren't here, right? Um, I tell clients, even if they're young, talk to your parents, find out what your parents have in place, right? Because somebody's paying for the funeral. And if they don't have any sort of final expense coverage in place, chances are it's going to fall on the family, and the family has to kind of either spread it around, put pressure on the family members to come up with money, or they have to put up a GoFundMe, et cetera, right?
Mhm.
Guaranteed issues are designed to say, hey, we can accommodate people with these types of health issues where we can get them generally between 10 to 50,000. And again, it's really designed to cover their final expenses, right? So there is hope. Um, you just have to know who who to go to, right? Which would be you and I, right? That's why we do this stuff so people are aware, right?
Yeah.
All hope is not lost, but there are options out there, even if you have a health history, even if you're older in years. I would say, however, if you are over 80 years old, it is it becomes close to impossible to insure
100%.
you, right?
Mhm.
So I like to say put that out there so people understand that yeah, there is I mean, I had a conversation 2 days ago. The lady was 86, right? And the conversation was, yeah, my friends told me to get it a long time ago. I didn't get it. I didn't bother to get it, but now I realize I need it, right? But yeah, this is a challenge, right? Where you wait too long to get it, and
Yeah.
then you're stuck in a scenario where no company wants to insure you, right? So,
And I think that it's not just necessarily no company wants to insure you, but at the same time, I mean, think about it. You're 86, turning 87.
mhm,
Potentially for underwriters, you're already 87, and we can
yeah,
get into the nitty-gritty of how that works, but potentially you're already 87,
yeah,
even though you haven't turned it yet. And imagine how much you're going to have to pay in premiums to cover yourself, even
yes,
if it was for $10,000, right? Like,
yes,
so um get it beforehand, right? At
yes.
100%.
As you were saying that, what came to mind as well, and I've done this with a couple of clients, is the premiums if you're older generally are more. Okay, that's just the honest truth, right? Because again, risk is higher. For a lot of people, they would look at the premiums. Let's say it's 100. Let's say it's $200 a month.
Mm.
They would say, "Oh my gosh, I can't afford it." So what I would generally say is, okay, think of it this way: someone's got to pay for it anyways. It's either you pay $200 a month now, or you pay the cost of the funeral, which was generally between 10 to 20,000. Either way, you're going to pay for it. So maybe if you have siblings, gather the siblings around and say, okay, let's all pitch in because we want to pay for this policy for our mother, our parents, whoever the case is. Let's pitch in and pay for it now. So that way we are all investing in making sure the final expenses are taken care of. Right. But that is a
100%.
way that you can it can be done even if the premiums for guaranteed issues tend to be a little bit higher.
Yeah, we've had that happen a few times where siblings have gotten together and said, okay, mom, dad, you guys can pay $50 a month. Great. We'll cover the rest. We'll divide it. Helps to
Yeah,
have more siblings than just one or two.
it does. Yeah.
Even the load, but we've had scenarios like that as well. I've had scenarios like that too. So not like you said, all hope is not lost,
Yes.
right? um Now, to understanding what type is right for you, we'll talk about riders a little bit, and understanding that as we said at the beginning, there's different types. Everybody is different. Everyone is going to have a different scenario. Also, how much you get in terms of, term or permanent, all that stuff. Again, everyone is different. So we can't give you a definitive answer, but we can customize, we can tailor it. And that's what you should be doing. This is what we don't know, right? If I go to Google right now and I look up that I want to get myself some life insurance, it's going to show me, like you said, more than likely a 10-year term. And I'll think, this is awesome. It's, inexpensive. I can get it real quick. It's accepted right now. However, I don't know that I have any riders on there because I'm not, versed in that to find out for myself. And then I don't know the differences between term and permanent and so forth. And getting into riders, basically, what that does is it allows us, and every company is different. Every company will have different riders. Essentially, they're like getting a combo pack. Okay,
Yes.
you go to McDonald's, you get your Big Mac, right? But you get it on its own. That's the life insurance policy on its own. Now you want to add in French fries.
Yeah.
Great, but you want to add in, McDonald's doesn't have these, but let's just say instead of French fries, you want to add in some onion rings, right?
Mhm.
Essentially, we're adding in different tools, which will increase your cost of insurance, but it gives you certain benefits that you wouldn't necessarily have with just the basic plan alone. A couple of things that you can get are adding a rider for critical illness. So you
Mhm.
can add rider for critical illness where you don't have to pay two different policies. You have it all in one shot, right?
Yes.
You can add a rider for disability with some companies where if I am, if I'm disabled for some period of time, I cannot do my job. I don't have a job at the moment. I can get some monthly expenses, to a certain degree, reimbursed for myself. There are some riders where if I am diagnosed with a critical condition, that
Mhm.
my premiums are waived,
Mhm.
you don't have to
Yes.
pay premiums. Again, all of these add little by little to making your premium more, which is why you shouldn't, and you should sit down and know the details of what you have, because sometimes you look at it and go, why am I paying $253 a month? Well,
Right.
you've got permanent, you've got term, you've also got riders. If something were to happen to you tomorrow and you cannot pay your premiums because of an illness or an accident, it's also covered. Your premium, your 253 is covered for as long as you need. So these things are important to know that they are options to you, right?
Yeah.
So make sure that when you sit down with someone, they offer different options and they ask questions.
Yeah.
We have some companies that allow us to give riders for when we are, we used to, in Canada, we used to have long-term care. But now, some of these companies allow us to have some sort of semblance of that,
Right.
right?
Yeah. Mhm. Yeah.
So it is 100% the um there is everything for everyone.
Mhm.
Everyone has an opportunity to have coverage,
Yeah.
right?
Yeah.
Anything else you want to add, Dwight?
Um, no, I think you pretty much covered it. I think, again, like I said, when it comes to creating your plan, it's really looking at what is the best plan for yourself, right? Or for that individual, right? So
Yeah.
ensuring that you have that conversation to make sure you have all the bases covered is always important, right? Um, and like I said, I mean, this is part of what we do is adding the education so people understand what they're getting, right? Because we believe the more educated you are, it's the better decisions that you'd make, right? So
100%. Yeah. Amazing. So, ladies and gents, remember that we are live again on Monday. And on Monday, we will be going through, actually, we're going to be talking about a fun one because you and I both have kids. And Monday, we're going to be talking about unlocking the benefits of insurance for kids. Oh my gosh. Taboo subject. Let's not talk about it.
yeah.
Hey. We are going to talk about it. We're going to bring it up because we want you to be informed and we want to make sure that anybody who has a child who you we all love them. We all adore them. I would hope so. You understand what's out there because this might be something that you truly, truly value and see value in.
Mhm. Yes.
So with that being said, ladies and gents, Dwight, thank you for being
Thank
on
you.
this live with me. Let's do it again on Monday. We'll see each other then.
Yes.
Friends, if you
Sounds
do
good.
anything tonight, watch the live, share it, and just bring awareness to life insurance, how it works, what types are out there, and you may be able to help someone make a
Yeah.
decision.
You got it. Have a good night, everyone.
Good night. Okay.